They told us it was a simple policy adjustment, a technical correction that only affected bankers and economists. Something too boring for ordinary people to worry about. Yet that quiet adjustment became the invisible switch that rewired the world's money system, opened the gates to extreme financial gambling, and planted a delayed explosion inside the global economy. And today, you are about to discover how that one decision changed the fate of nations, erased trillions of dollars, and quietly transferred wealth from millions of families into the hands of a few powerful institutions. And before we go any further, subscribe and visit the channel for the next video, because the next hidden decision may already be forming right now. At the beginning of the 2000s, life looked stable. Home prices were climbing, banks were smiling, and credit felt unlimited. Advertisements promised that anyone could own a house, build wealth, and secure their future. Loans were approved in minutes. Paperwork felt like a formality. It felt like the system was finally working for everyone. But inside the financial world, something very different was happening. Banks were no longer thinking about long-term safety. They were thinking about speed. They were thinking about volume. They were thinking about profit today, not stability tomorrow. Instead of carefully checking whether borrowers could actually repay loans, many institutions began approving risky mortgages to almost anyone who applied. These were not always stable families with reliable incomes. Some people were approved without proof of earnings. Some were given loans that would suddenly become much more expensive after a short introductory period. Inside the industry, these were quietly labeled as higher-risk loans. But instead of slowing down, banks found a way to turn risk into gold. They began bundling thousands of these risky mortgages together, slicing them into pieces, and selling them as investment products to pension funds, insurance companies, and even governments around the world. These products were marketed as safe, stable, and low-risk. They were given impressive names, complex structures, and most importantly, high safety ratings. On paper, they looked like solid investments. In reality, they were financial landmines. The safety ratings were often issued by agencies that were paid by the same banks creating the products. This created a dangerous conflict of interest. The more safe a product was labeled, the more money everyone involved could make. So the warnings were softened, the risks were hidden, and the system kept growing. Behind all of this, a powerful regulatory wall that once protected ordinary depositors from higher-risk financial gambling had been quietly weakened. A single regulatory change allowed massive banks to mix everyday savings with extreme financial speculation. This meant your deposits were no longer just sitting safely in a vault. They were now fueling risky bets across global markets. The fuse had been lit. As long as house prices kept rising, the illusion held together. People could refinance. Missed payments could be delayed. New loans could cover old ones. The machine kept feeding itself. Then, quietly, prices stopped rising. A few borrowers missed payments, then more did, then thousands. And suddenly, the hidden truth emerged. The safe investments were built on unstable foundations. Once people could no longer pay their mortgages, the products created from those mortgages lost value. And when those products lost value, banks realized something terrifying. They were all holding pieces of the same collapsing structure. Nobody knew which institution would fall first. Trust vanished almost overnight. Banks stopped lending to each other. Businesses couldn't access credit. Companies froze hiring. Factories slowed down. People lost jobs. Stock markets plunged. Pension funds shrank. The ripple turned into a wave. The wave turned into a global crash. Governments were forced into emergency meetings. Leaders feared that if major banks collapsed, the entire financial system could collapse with them. So they made another shocking decision. They used public money to rescue the very institutions that had helped create the disaster. Banks were stabilized, but families were not. Millions of people lost their homes. Savings were drained. Entire communities were damaged. And the world entered one of the most painful economic periods in modern history. Years later, many believed the system had been fixed. New rules were announced. New protections were promised. But beneath the surface, much of the same structure remained. The same incentives, the same power dynamics, the same dependence on complex financial products that most people still do not understand. Today, Warning signs are appearing again. Debt levels are rising. Housing markets are under pressure. Financial instruments are becoming more complicated. And decisions are once again being made quietly behind closed doors. The global economy does not collapse with explosions. It collapses with meetings. It collapses with signatures. It collapses with paperwork. And those who are not paying attention are usually the ones who pay the highest price. Understanding how money really works is no longer optional. It is protection. It is survival. It is the difference between being prepared and being caught unaware. Because the most dangerous financial events are not the ones you see on the news. They are the ones being planned before the news even knows they exist. So now, the real question is not what happened back then. The real question is what is being decided right now, and whether we will see it before it's too late. Visit the channel for the next video, because the next decision could already be happening.